Welcome to the Deep Dive. We're the show that takes a whole stack of sources, pulls out the really key stuff, and helps you get up to speed fast.
Yeah, getting you informed quickly.
Exactly. And today we're tackling a word that, well, it often sends shivers down people's spines: debt.
Definitely has a bad rap.
We usually think of it as just a burden, right? Something to avoid. I mean, experience says the average American adult owes over $104,000. That's a heavy number.
It really is. It can feel overwhelming.
But what if that whole perception is maybe incomplete? What if debt isn't always the enemy? What if it could actually be, I don't know, a strategic tool? Maybe even a kind of superpower for your finances.
That's the big question we're digging into.
So in this deep dive, our mission is to maybe transform how you understand debt, move it from something scary to potentially a powerful lever for financial growth.
We've got some great sources lined up, insights from big names like Fidelity and Experian.
Yeah, plus a really interesting YouTube discussion with Robert Kiyosaki, some expert analysis from Vertex Planning Partners, and even the American Medical Association chimed in.
So a good mix. Let's unpack this financial puzzle.
Okay, where do we start?
Well, I think the most fascinating thing, and where the common view often trips up, is missing a really crucial distinction.
Which is?
That debt isn't just one thing. It's not monolithic. It actually has two very different faces. You got good debt and you got bad debt.
Right. Two sides of the coin.
Exactly. And getting your head around that difference, that's the first absolutely vital step if you want to turn debt from, a burden into something strategic.
Okay, so let's start with the positive side then. Shine a light there. What actually is good debt? How do we spot it?
So the core idea, really, is that good debt helps increase your net worth over time, or it helps you generate future income.
It's an investment.
It's an investment, plain and simple. And critically, as Fidelity points out, it usually comes with a lower interest rate, often like under 6%.
Right.
It's about using borrowed money to create more value than what that borrowing cost you.
Okay, makes sense. And a classic example people talk about is education loans, right?
Yeah, that's a big one.
They can feel really heavy, but generally they fall into that good debt category because, well, more education can significantly boost your future income. Fidelity actually had a stat on this. The typical college grad earns, what, $579 more per week?
Yeah, that's about $30,000 a year more than someone with just a high school diploma.
Wow. That can potentially double lifetime earnings, plus lower unemployment rates. It really is an investment in yourself.
That's absolutely right. But, and this is important, it's not like a blanket rule. There are nuances here.
Okay, like what?
Well, for student loans to really be good debt, a couple of things need to be true. They need those low interest rates. Federal loans often have them, but private loans, they can be all over the map, interest-wise.
Right, much higher sometimes.
Yeah. And crucially, the education itself needs to genuinely help your career prospects, both short-term and long-term.
So the degree actually needs to pay off.
Exactly. Robert Kiyosaki, in that YouTube discussion we looked at, he actually flagged some student loan debt as particularly bad.
Oh, interesting. Why?
Because unlike, say, business debt, you generally can't discharge student loans in bankruptcy. It sticks with you.
Ah, okay. That's a big difference.
Huge. He really emphasizes, know if you're actually going to graduate, know what your job prospects look like. He even mentioned how things like AI are changing those traditional high-paying jobs, like lawyers and accountants.
So it raises a really important question for you, the listener. Is that degree you're thinking about or currently pursuing genuinely going to boost your earning potential? Or are you just racking up high-interest debt for a path that, well, might not lead where you hope?
It's a tough question, but a necessary one.
Yeah.
Kiyosaki told this story, right, about two friends who were doctors.
Yeah, I remember that. They came out with, what, $500,000 in student debt?
$500,000. But they paid it off in 5 years because they landed those high-paying doctor jobs. The education paid off.
But then he contrasted that with another friend.
Right, who changed majors 3 times, piled up the debt, and ended up kind of stuck in a nursing career she didn't even like.
It really shows you need a plan. You need to be intentional about it.
Absolutely. Now, zooming out a bit, let's talk about debt for building wealth, like mortgages for homes or real estate.
Okay. Generally seen as good debt, too, right?
Historically, yeah. One of the safest forms, really. They tend to have lower interest rates, and there's the potential to build equity as the property value hopefully goes up.
And home equity is huge for a lot of people.
It's the biggest asset for nearly 2/3 of Americans. Median value around $299,000. And home prices, well, They've appreciated significantly, like 319% overall since 91, and even 5.7% just last year alone.
Wow. And you can tap into that equity too, right? With things like home equity loans or HELOC.
Exactly. That's a home equity line of credit. Gives you flexibility. So yeah, a mortgage for your primary home, generally good debt for most people.
But Kiyosaki, he pushes this idea further, doesn't he? With his whole cash flow is king philosophy.
He really does.
Yeah.
He challenges that whole get out of debt mantra that you hear everywhere.
How so?
He argues that debt can be incredibly powerful if you use it to generate income. So for him, your personal home, it's typically a liability.
Even if you own it outright.
Yeah, because cash flows out for taxes, insurance, repairs, depreciation. It doesn't put money in your pocket.
Okay, that's a different way of looking at it.
It's a critical shift.
Right.
A rental property, though, that becomes an asset if it consistently puts money in your pocket after all expenses. Doesn't matter how you financed it.
He actually used a credit card for his first rental, didn't he?
Famously.
Yeah.
Bought it for $18,000. It made him $25 a month clear. Now he owns like 6,500 rental properties, often financed 100%. It shows how debt, if it creates positive cash flow, can actually build assets for you.
That is seriously counterintuitive. It means even a credit card, which we usually think of as the absolute poster child for bad debt,
Right.
could theoretically be good debt if the money you spend on it generates income or buys an asset, like Kiyosaki buying that first property.
Exactly. It's about what the debt does.
Yeah.
And speaking of generating income, business loans are another really powerful example of good debt.
Right, helping businesses grow.
Yeah, our sources highlight they could be a catalyst for just rapid expansion innovation. Think of it like adding rocket fuel to a company.
Okay.
A strategic business loan isn't just capital. It's often the accelerator. It lets you make leaps in production, upgrade technology, grab more market share, things that might take years otherwise.
So investments that fuel growth, not just buying stuff.
Precisely. It's future-oriented.
Okay, so we've explored debt as potentially an ally, but every financial journey has its traps, its pitfalls. Let's flip the coin now and look at bad debt, the kind that can really drag you down. What defines that?
So bad debt, generally, it finances purchases that won't increase your net worth or future income. Often, it's for stuff that loses value quickly, depreciates.
Like cars, maybe? Or just day-to-day spending?
Could be. And it's usually marked by high interest rates, either right away or down the road. The American Medical Association's take really echoes this. They basically say bad debt is when you use credit cards for, disposable things or even durable items, but you don't pay off the balance in full each month.
So you end up paying interest on something long after you've used it up or its value has dropped.
Exactly. Paying for last month's dinner for the next 6 months with interest.
And the biggest culprit here, it has to be the credit card trap.
Oh, absolutely. It's psychologically just so easy to overspend. Swiping that plastic, it just feels less painful than handing over actual cash.
Yeah, it does, and the numbers show it. Experian's 2023 study found the average American has almost, $6,500 in credit card debt?
Almost $6,500.
Yeah.
And with those high APRs, annual percentage rates sometimes over 20%, repayment gets incredibly expensive. And often, the purchases are things that are consumed quickly. Food, clothes, entertainment. You're left with very little to show for the debt itself.
It's like that new gadget, right? Feels great for a week, then you're stuck paying it off for months, and it's already outdated or just sitting there.
Totally. And watch out for retail store credit cards, too. They can be especially problematic.
Why is that?
Often sky-high interest rates. Plus, applying for lots of them can ding your credit score because of all the inquiries.
Ah, right. So why do people fall into this trap, though? Is it just overspending?
Sometimes.
Yeah.
But often, it's also because people don't have enough emergency savings. So when something unexpected happens, car repair, medical bill, the credit card becomes the default option.
The only option, maybe?
Right. And beyond credit cards, you've got other types of high-interest loans. Generally, anything with an interest rate maybe 6% or higher.
Yeah.
Think payday loans, some personal loans.
Yeah.
They also fall squarely into that bad debt category.
Because they're hard to pay back.
Really hard. The compounding interest just makes them grow and grow. TransUnion found nearly 4% of people with personal loans are over 60 days late on payments.
Ah.
They should really only be used in absolute emergencies when every other option is gone. And even then, you need a rock-solid plan to pay it back ASAP.
Okay, so understanding good versus bad debt, that's like the foundation. But to really use debt effectively, maybe even as that superpower we talked about, there's another huge piece. your credit score.
Absolutely critical.
Why is this 3-digit number just so incredibly important for your financial life?
Well, think of it as your financial reputation, like a trust score, almost.
Hmm.
Good credit is absolutely crucial.
It's for getting loans, obviously.
Yeah, lower interest rates on loans, better credit card rewards, but it goes beyond that. It can affect whether you can rent an apartment, get certain jobs, even what you pay for insurance. It's basically a reflection of how well you've managed debt in the past.
And the score everyone talks about is the FICO score, right?
Right. That's the main one, yeah. Typically runs from 300 up to 850. Lenders use it, landlords, employers, insurers. They all use it to gauge risk.
But how is that number actually put together? It seems kind of mysterious sometimes. Can we break down the factors that really shape that FICO score?
Yeah, definitely. It's not as mysterious as it seems. There are 5 key factors, and understanding them gives you a lot of power.
Okay, let's hear them.
First, and this is the heavyweight, payment history. It accounts for 35% of your score.
35%. Just from paying on time.
Yep, consistency is king here. Paying all your bills on time is absolutely essential. Even one missed payment, if it's 30 days late or more, can have a really drastic negative impact. This is your foundation.
Okay, number 1, pay your bills on time. Got it. What's next?
Next up, accounting for 30% is amounts owed.
So how much debt you have overall?
Partly, but it's not just the total dollar amount. A really critical piece here is your credit utilization rate.
Ah, right. That's the ratio of your credit card balances to your credit limits.
Exactly. Keeping that ratio low, the usual advice is ideally below 30% is really key.
Wow, so just those 2 factors, paying on time and keeping balances low relative to limits, that's 65% of your FICO score right there.
That's right. Nearly 2/3 of your score hinges on just how consistently you pay and how little you owe compared to your available credit. Get those right, and you're well on your way. Those are your credit superpowers.
Okay, what makes up the other 35%?
All right, next is length of credit history. This counts for 15%.
Mm-hmm.
Basically, the longer you've managed credit responsibly, the better it looks to lenders.
So older accounts are good.
Yeah, it includes the age of your oldest account, your newest account, and the average age of all your accounts. Time is on your side here if you manage it well.
Makes sense. Then
Then you have credit mix, which is 10%.
Yeah.
This is about showing you can handle different types of credit responsibly.
like having both credit cards and maybe an installment loan, like a car loan or a student loan.
Exactly. Revolving credit-like cards and installment loans where you pay a fixed amount over time. Having a mix and managing it well can help your score. Shows versatility.
Okay. And the last 10%.
That comes from new credit. Every time you apply for new credit card, alone the lender runs a hard inquiry on your report.
And that lowers your score.
Temporarily, yes. Too many inquiries in a short period can signal risk, like maybe you're desperate for credit or about to take on a lot of new debt. So it's generally wise to space out your credit applications.
Good tip. Okay, so those are the 5 factors. What score range are we actually aiming for? What's considered good?
Generally speaking, a FICO score of 700 or above is considered good. The ranges usually break down something like this. Exceptional is 800, 850. Very good is 740, 799. Good is 670, 739. Fair is 580 or 669. And poor is anything below 580 down to 300.
Okay, so hitting that 700 mark is a decent goal.
It's a good benchmark, yeah. Opens up a lot more doors.
So, knowing how it's calculated is one thing. But how do you actually build or improve your credit, especially if you're starting from scratch or maybe have some past mistakes?
Great question. It's definitely doable. For folks just starting out or maybe with poor credit history, there are specific tools. Secured credit cards are a great option.
How do those work?
You put down a refundable security deposit, maybe a few $100, and that amount usually becomes your credit limit. Use it like a regular card, make payments, and that activity gets reported to the credit bureaus, helping you build history.
Okay, kind of like training wheels for credit.
Sort of, yeah. Student credit cards are another one, designed for college students, often without needing a deposit, sometimes even offering rewards.
What else?
You could become an authorized user on someone else's card, like a parent or spouse, with good credit. Their positive payment history can then appear on your report. That can be a quick way to establish some history.
But you have to trust that person manages their card well, right?
Oh, absolutely. Their mistakes can hurt you too. There are also credit builder loans. These are small loans specifically designed to build credit. The lender holds the loan amount in an account while you make payments. Once it's paid off, you get the funds, and your on-time payments have been reported all along.
Interesting. So you prove you can make payments before getting the cash.
Exactly. And even just taking out necessary installment loans like for a car or a student loan or a mortgage and making those payments on time will naturally build your credit history.
Okay, so those are ways to start. What about just managing the credit you already have effectively? Proactive management.
Right. Number one, absolutely non-negotiable. Pay bills on time. Every single time. That's the single most impactful thing you can do.
We heard that loud and clear with a 35% weight.
Exactly. Second, keep that credit utilization low. We mentioned under 30%,
Sure.
but honestly, lower is even better if you can manage it. Pay down those balances. Here's a pro tip. You can sometimes request a credit limit increase from your card issuer.
And how does that help?
Well, if they approve the increase, and this is key, you don't increase your spending, your utilization ratio automatically goes down because you have more available credit relative to your balance.
Ah, clever. Without actually paying anything down.
Right. Also, look into services like Experian Boost. They let you add payments you're already making, like rent, utilities, phone, even streaming services to your Experian credit report. If they're on-time payments, it can sometimes give your FICO score an instant little bump by adding more positive payment history.
Oh, that's cool. Leveraging bills you pay anyway.
Precisely. But just as important as knowing what to do is knowing what not to do. Mistakes to avoid.
Okay, like what?
Big one. Not monitoring your credit reports regularly. Errors happen. You need to check for inaccuracies that could be dragging down your score. You're entitled to free reports from each bureau every year.
Good point. What else?
Not having a budget. If you don't know where your money's going, it's easy to overspend on credit. Only paying the minimum amount due on your credit cards that keeps you in debt longer and costs a fortune in interest. Applying for new credit too often, as we mentioned.
Right, those hard inquiries.
Yeah. And here's one that trips people up. Closing old credit card accounts, especially your oldest ones.
Wait, why is closing an old card bad? Seems like tidying up.
It feels like it, but it can actually hurt your score in two ways. One, it shortens the average length of your credit history. Two, it reduces your overall available credit, which can instantly increase your credit utilization ratio if you carry balances on other cards.
Ah, okay. So keep those old unused cards open, assuming they don't have an annual fee.
Generally, yes. Just maybe use them occasionally for a small purchase and pay it off to keep them active. And finally, if you feel like you're really struggling with debt, don't be afraid to seek help. Credit counseling agencies often offer free consultations and can help set up debt management plans. You don't have to figure it all out alone.
That's really good advice. Okay, so we've covered good versus bad debt. We've demystified the credit score. Now let's get into what feels like maybe the ultimate level of debt mastery. Using leverage.
Right, the power of leverage.
Beyond just avoiding bad debt and building good credit, how can debt become a truly strategic asset?
Yes.
Something that actively amplifies your financial position?
This is where the mindset really shifts. The concept of leverage, it's easiest to grasp with that classic physical analogy, right? Archimedes and the lever.
Give me a lever long enough and a fulcrum on which to place it, and I shall move the world.
Exactly. A small force can lift a really heavy weight.
Yeah.
In finance, it's the same idea. Vertex Planning Partners puts it simply. Leverage means using borrowed funds, someone else's money, to increase the potential return on your own investment.
Okay.
You're basically using other people's money to make your money work harder for you.
Can you give an example?
Sure. The sources had a good one. Imagine you want to buy a $10 million property. You can pay all cash if you have it. Or you could put down, say, $4 million of your own money, your equity, and borrow the other $6 million via a mortgage.
Okay. So you're controlling a $10 million asset with only $4 million of your own capital.
Precisely. You're controlling an asset that's 2.5 times greater than your initial investment. That 2.5x. That's your leverage ratio.
And what's the benefit of doing that?
Here's where it gets compelling. If the expected return on that property from rent, appreciation, etc., is higher than the interest rate you're paying on that $6 million loan,
Then you make more money.
leverage can substantially boost your return as the equity investor. The sources showed an example. If the property has a 10% total return and your loan is interest only at 8%, your return on your $4 million equity could jump to 13%.
Wow. So instead of making 10% on your $4 million if you bought a smaller property outright, you're making 13% on that same $4 million by leveraging up to buy the bigger one.
That's the amplification effect. You're making a higher percentage return on your invested capital.
Okay, but that sounds almost too good to be true. There has to be a catch, right?
Well, there's no free lunch, as they say. The flip side, the twin of amplification, is magnified risk.
Meaning?
Just as leverage boosts potential gains, it also boosts potential losses. Let's take that same example. But imagine a pessimistic scenario. Maybe the property market dips.
Okay.
If you paid all cash, no leverage, maybe you only suffer a 1% loss. But for you, the levered equity investor with the $6 million mortgage, that same market dip could translate into a painful 14.5% loss on your $4 million investment.
Ouch. So the downside gets magnified by that same 2.5x leverage ratio.
Often, yes. The risk magnification factor tends to equal the leverage ratio. It's important to understand, though, it's not necessarily an additional risk for you, the borrower, beyond what's inherent in the investment itself.
What do you mean?
Well, that magnified potential loss is part of the range of outcomes for your investment. Or in some cases, particularly with certain types of loans like non-recourse loans common in commercial real estate, the ultimate risk beyond your initial investment actually falls on the lender.
How so?
Because with a non-recourse loan, if things go really bad, you might just hand the keys to the property back to the lender. Your maximum loss is capped at the equity you put in your $4 million in our example. Your other personal assets aren't typically at risk. The lender takes the hit on the rest.
Ah, okay. That distinction matters. Now, is there a way to sort of quantify this, how mixing your money and borrowed money affects things?
Yeah, there is. It gets a bit technical, but there's a concept called the weighted average cost of capital, or WACC.
Okay.
Basically, imagine you're blending your own money, equity, with borrowed money, debt, to finance the asset.
Yeah.
The WACC formula helps you calculate the average cost of that total pool of capital. It clearly shows how adding debt changes your overall expected return and the risk you're taking on your equity portion.
So it connects the property's overall return to the return the debt holders get, the interest, and the return you get on your equity.
Exactly. It shows how the property's return is essentially a weighted average of the debt return and the equity return. You can even flip the formula around to figure out what your expected equity return should be given the property return and the cost of debt.
Okay. And this leads to the idea of positive versus negative leverage.
Right. It's pretty straightforward. Positive leverage is when using debt actually increases your return as the equity investor.
Which happens when?
That happens when the return you're getting from the underlying property is higher than the interest rate you're paying on the mortgage loan. Borrowing at 5% to invest in something returning 8%, that's positive leverage.
Makes sense. And negative leverage.
That's the opposite. It's when using debt actually decreases your return. This happens if the property's return turns out to be lower than the cost of your debt.
Like borrowing at 7% for an investment that only ends up returning 4%.
Exactly. In that case, the debt is actually dragging your overall return down. You'd have been better off not borrowing or using less debt. You're effectively losing money by borrowing.
Got it. Now, you mentioned earlier how leverage affects returns. Does it change where the returns come from?
Yeah, that's an interesting point from the sources. Leverage tends to shift the nature of the expected return for the equity investor. It typically pushes it away from current income, like cash flow from rent,
Okay.
and more towards capital appreciation, meaning the increase in the property's value over time.
Why does that happen?
Even if you have positive cash flow, sometimes called cash-on-cash return, the property's value is likely growing at a faster percentage rate than the loan balance is growing or shrinking if you're paying principal.
Right.
So proportionally, more of your total return comes from that growth in value rather than the annual cash flow.
So leverage might mean less cash in your pocket year to year, but potentially a much bigger gain when you eventually sell the asset.
That's often how it plays out, yes.
Okay.
The growth component gets amplified more than the income component.
Fascinating. So clearly, leverage can be incredibly powerful, but also risky.
Absolutely. Which means to truly harness debt as an asset, responsible management is paramount. It's not just about borrowing. It's about borrowing smartly.
So what does that involve?
It means really honestly assessing your own tolerance for risk, developing a very clear strategy for how that borrowed money is going to drive growth or generate income, continuously monitoring your debt levels relative to the asset value, and crucially, having a realistic repayment plan.
It's not just set it and forget it.
Definitely not. What this all tells us is that debt, when you approach it strategically, when you manage it responsibly, it really can be a powerful amplifier for building wealth. It doesn't have to be just a liability weighing you down.
Okay, so let's try and wrap this all up. What does this journey through the world of debt mean for you listening right now?
Well, we've gone from seeing debt as this, dreaded burden.
Yeah, something to just avoid.
To understanding it as a much more nuanced financial tool. We've seen how good debt can be a real engine for personal wealth think education, buying a home, and how it can be a catalyst for business expansion, getting into new markets, upgrading tech, hiring talent.
Right. But we also looked at the other side. We pinpointed how bad debt, high-interest credit cards, loans for depreciating assets can be a serious drain on your finances, like a leaky faucet just constantly dripping away your money.
Yeah. And we unlock the power of your credit score, understanding it as your financial reputation. We broke down those 5 key factors that shape it and talked about real strategies for actively building and improving it.
And finally, we explored that advanced concept of leverage, how using borrowed money strategically can amplify your returns, turning liabilities into potential opportunities, even though, yes, it absolutely comes with magnified risk.
It really is about being intentional with it.
So I think the key takeaway here, the big message, is that knowledge about debt truly empowers you.
No.
It's not necessarily about avoiding debt entirely. Maybe that's not even realistic or optimal for everyone. It's about understanding its mechanics, the costs, the benefits, how it actually works, and then learning how to wield it with intention, with purpose.
That's like any powerful tool, right? You need skill, you need respect for it.
Exactly. So the final thought for you to chew on is this. How will you use these insights? How will you start looking at debt in your own financial life, maybe shifting some of those liabilities into real opportunities?